418. And also, I would like to welcome NESA management and support staff, and as well as stakeholders that have joined our meeting this morning. And before I do that, let me first start by introducing the members of the REC, starting with myself. My name is Nomalanga Stole. I am the chairperson of the REC and the CEO at NESA, and I sit on other structures of the energy regulator. I would then move on to the next member of the committee, Mr. Mkhize. Do you want to greet?
Greetings to you, Chairperson, fellow member Maseti, management and staff of NERSA, as well as the members of the public that are following us through the various live streaming platforms. Thank you.
Thank you, Mr. Mkhize. And just to formally indicate that you are a chairperson of the Petroleum Pipeline Subcommittee and a member of other subcommittees and committees of the Energy Regulator. On that note, I'll then move on to Ms. Maseti, who is the member of the REC, chairperson of the Pipe Gas, and the chair of the Electricity Subcommittee. And she sits on a number of subcommittees and committees of the Energy Regulator. On that note, Ms. Maseti, do you want to greet everyone?
Good morning to you, Chairperson, Mr. Mkhize, good morning, and the members of the management at NERSA, as well as the various stakeholders that are following today's meeting. Thank you, Chair.
Thank you very much, Ms. Maseti. We do have an agenda that has been submitted for this particular meeting. Can I, by a show of hands, get an indication that the members do adopt the agenda as presented? Members? Thank you, Ms. Maseti. I do support as well, and thank you, Mr. Mkhize. Any declaration, any verbal declaration of interest that you may have, members? I don't see any hand. On that note, may I request that members complete the forms that have been provided for the declaration of interest, and also to all the NESA personnel to really do the same and submit it to the secretary for this particular meeting. On that note, in terms of our open session of the meeting, we are going to be starting with matters that relate to the regulation of the pipe gas. We will start with item 5, which is the Republic of Mozambique Investment Company Proprietary Limited's full year financial reports for the period 1 July 2024 to the 30th of June 2025. Mr. Nomalo, if you can lead us in terms of the submission or guide the committee as to who's going to lead the submission, and also be mindful of the time that we have agreed on in the closed session in terms of how we should proceed, based on the fact that we have a very long agenda for today. Over to you, Bob.
Thank you, Chairperson, and good morning to members and good morning to colleagues. Chairperson, this one will be presented by Mr. Khosa. Just to state that these are the regulatory financial reports submitted by ROMCO as required by the RRMs. Thank you.
Good morning, Chairperson. The presentation will be done by Melusi Ngobeni. Good morning, members and colleagues, as well as stakeholders. The purpose of this submission is to request the REC to approve ROMCO's RFRs for the period 1 July 2024 to 30 June 2025, submitted in compliance with the requirements of Volume 1 of the RRMs. Our evaluation of the RFRs covered the administrative procedures, the audit report, the comparison of the actual and prior year estimates, as well as the ratio analysis. ROMCO submitted the RFRs on the 28th of November 2025, within 6 months of its financial year end. A summary of ROMCO's compliance with the administrative requirements is attached as Annexure A. PwC submitted the audit report, and PwC reported that ROMCO's RFRs present fairly in all material aspects the financial information as at 30 June 2025. Table 1 on page 5 compares the volumes transported in the current year compared to the previous year, and there is a slight decline in the volumes transported, and that is due to the Sasol gas decline of volumes under GTA 3. Chair, the REP on table 4 on page 7 is increased slightly by 0.44%, and then the major contributor to this increase was the assets under construction and work done on the compressor equipment, the mains, and the PPS. Chair, on table 7 and table 6 and 7 on page 8 and 9 respectively, it indicates that ROMCO has sufficient funds set aside for the decommissioning of GTA 2 and 3. Chair, in terms of the overall financial performance of ROMCO, although the revenue and volumes have declined slightly, the liquidity ratios have improved, indicating that the company is capable of meeting its financial obligations within the allocated time. Chair, the recommendations are on paragraph 14 on page 15. Thank you, Chair.
Thank you very much, Mr. Ngobeni. Members, any questions, issues of clarity or points of enhancements that you may have in relation to this particular submission? If you have any, please do raise your hand. Thank you, Mr. Mkhize. You may proceed.
Thank you, Chairperson, and thanks, Mr. Ngobeni and Mr. Nimar. From my side, it's just mainly two issues. If you go to table 1 on page 5 of 120, if you can just please just correct the units there. The figures are confidential, but if you can just correct that, because that it indicates huge figures. And I think on the last one, you don't even have the gigajoule to indicate that. And then secondly, my understanding is that, contrary to what you have said, is that currently they don't have sufficient cover for decommissioning cost. But if you look at 4.34 paragraph there, but that they are going to increase the annual contribution, or the annual contributions have been increased towards that, so that they can cover that shortfall. And I think that the reasonableness thereof, although it's something that to be dealt with elsewhere in terms of the tariff, should also be borne in mind going forward, being properly justified. Just wanted to highlight that. And if maybe my understanding is wrong, I stand to be corrected. Thank you.
Thank you, Mr. Mkhize. I don't see any hand. I think from my side, what I wanted to check. Oh, I see Ms. Maseti's hand is up. You may come in, ma'am, before I do.
Thank you, Chairperson. Chairperson, on the issue that Mr. Mkhize raised with regards to the increase for the decommissioning allowance, this is an issue maybe that the committee needs to make sure that the team looks at it carefully, because some of these assets are sitting outside the borders of South Africa. For instance, the Loop Line 3, which is under GTA 3 in terms of the agreement. And those volumes are not volumes that are only benefiting South Africa, but there are additional volumes that are also for the companies that are in Mozambique, which are then sold to companies that are in South Africa, but they are not for they are not just those that are benefiting one shipper, for so to speak, which is Sasol in this case, but there are others that are independent and are getting these volumes through the Mozambican companies. So it is very important then that we look carefully as to who must then be responsible for the decommissioning of those the costs that are put aside for decommissioning, whether those costs are supposed to be carried out by customers in South Africa, if some of the volumes, because they go into one pipeline anyway. So this is something that needs to be looked at carefully. One pipeline is short, it is a loop, but it then transfers back to the main pipeline all the way. So it's just at the point at the inlet flange that those loop lines are, so that the diameter is is increased, and then later on just it goes back into the main pipeline. So it is important that we look carefully as to who must carry the cost for those in terms of the decommissioning allowance. In as much as the point is raised there, but it is something that we need as a principle to look at carefully how it is supposed to be handled. Thank you, Chair. I wanted to just bring that aspect so that this is not going to result in a higher tariff by ROMCO for the South African customers, when in fact there are other players that are also supposed to carry the cost. Thank you, Chair.
Thank you. Maybe just a follow-up on your input, Ms. Massetti. So does it then mean that we proceed to approve this or consider the recommendations as made prior to really having that particular assessment being done on who should cover the cost of the decommissioning? If you can guide on that, I'll appreciate it.
Thank you, Chair. Yes, Chairperson, the report is just indicating things that they have picked up. So the report is fine, but the allowance itself, it comes through the tariff when there's application for the tariff. So that's when it needs to be scrutinized and then see how others are supposed to contribute to that, whether this is going to the customers. Thank you, Chair.
Thank you very much. And I think one last point, maybe on this submission, which is from my side, it's the issue of maybe the RRMs. My understanding was that volume 1 of RRM was revised last year and also gazetted. But I see in the submission, we are not mentioning that. Is there a specific reason for that? If that can be responded to, I will also appreciate it. Over to you, Mr. Numano and team, to respond.
Chairperson, I think to start with, maybe let me start quickly and then Mr. Ngobeni can come in. Just to start with the issue raised by Mr. Mkhize on table 1, yes, it is correct that I think there can be proper enhancements on that table. I think we'll do that, including just an indication of the gigajoules there. And Mr. Mkhize also referred to paragraph 3.4.34. I think, yes, it is correct that there was a shortfall, Mr. Mkhize. And I think in realization of that shortfall, ROMCO is then committed to basically do a catch-up. And I think they're going to basically aim to catch up next year. So by next year, they would have actually gotten to the stage where they've got sufficient and adequate reserves and to basically deal with any decommissioning costs. Mr. Ngobeni, then you can come in and deal with the other issue raised by Advocate Tony and Ms. Massetti. And I think Ms. Massetti is just basically a guidance as to what enhancements and what work needs to be done around the issue.
Thank you, EM, and thank you, Chairperson. I think we accept the additional work that also needs to go into the decommissioning. However, I just want to indicate that because of the fact that we have struck through the numbers, it won't come out clear. However, the current year's contribution covers the shortfall that was indicated in table or paragraph 4.34. So we are indicating as though the GTA had a shortfall, but this current year's contribution to decommissioning would result in there be sufficient reserves for the decommissioning of GTA 3. I think, and then as well as we will make that paragraph, I think, much more clearer, Chair. I think it's an issue of enhancing also paragraph 4.34 to make it clearer as to whether there is a shortfall or not. However, there is a shortfall based on the present value of the decommissioning cost. However, the current year's contribution will then make sure that that shortfall is being covered. I think that's where we would like to maybe do an enhancement on that paragraph. And then on the comment made by the CEO, I think we were supposed to also just indicate, yes, in the submission that there was an amendment done on the RRM Volume 1 that was approved on 30 May 2025. However, we didn't indicate that in the background of the RRMs. I think it's an enhancement that you can take going forward. Thank you, Chair.
Thank you very much, Mr. Ngubane and Mr. Ngumane. There's a follow-up from Mr. Mkhize. You may come in, sir.
Thanks. I appreciate the responses, but from where I'm sitting, I think what is best is that we can go on and take a decision on it. I'm not averse to approval, noting that we also need to be decisive as a committee. But I don't think that we should take the matter to when the matter of the decommissioning cost to when there's a tariff application. I think as a next step or action item coming out of this, there should be just a comprehensive response to that. We deal with it like that, because then it will then feed back into the tariff assessment going forward. But I think let's deal with it in that manner as what the team should look into, the best way to deal with the issue of financial provision for decommissioning costs of the whole pipeline, noting that some portions of it are within Mozambique and the other portion is within South Africa. Thank you.
Thank you very much, Mr. Mkhize. I think that's just a guidance that's being provided. And I think on that note, we would then have to move on to the recommendations, which are on page 15. I'm seeing
there's a hand from Mr.
Yes, I'm seeing it. Choko, you may come in.
Thanks, Madam Chairperson. Good morning. Chairperson, the recommendation should be for noting we have guided colleagues to say even the citation of the delegation metrics is wrong, it's 5.3, and in terms of the new delegation metrics, the RFRs are coming here for noting. Thanks, Chairperson.
Okay. Thank you for that guidance. Colleagues, if we can note that the recommendations are on page 15, we'll just have to amend that, and as well as the paragraph of the authority, and also I do note that it has been cited verbatim as Mr. Mkhize has been proposing in a number of meetings. If we can do that and maybe highlight it in italics, that will really help. And as we have been guided just now by RSU, we would have to amend the recommendation to say that it is for noting. And just to read the recommendation into the record, the recommendation is that ROMCO's full year regulatory financial report for the period 1 July 2024 to the 30th of June 2025 submitted in compliance with the requirements of the Regulatory Reporting Manual Volume 1 as attached as Annexure C are to be noted. And I think the additional action that has been made is that The team looks at the decommissioning cost, which must be dealt with as soon as possible, but rather than to wait for when the tariff really is submitted to the energy regulator. On that, members, can I get an indication that you support the noting and as well as the additional action items given to the team? Thank you, Mr. Mkiza. I also support the noting, and thank you, Ms. Masetti. The submission is being noted. We then move on to another item under the pipe gas regulation, which is item 6. Over to you, Mr. Ngumalo. And just to read the title into the record, it is a submission on the Transnet SOC Limited's cost allocation manual submitted in compliance with the requirements of the RRMs. Over to you, Mr. Ngumalo, and you can guide from your team as to who is going to lead the submission for the committee. Thank you.
Thank you, Chairperson. It will be Mr. Ngobeni again on this one, just to indicate that, as Mr. Chokwe has just indicated, we will then do the correction similarly on this one with regard to the delegation of authority, paragraph number 3.
Thank you, and good morning, Chairperson and members and colleagues. The purpose of this submission is to request the REC to approve Transnet's cost allocation manual submitted in compliance with the requirements of the regulatory reporting manuals. The RRM Volume 1 prescribes that each licensee must submit to the energy regulator a CAM for approval as soon as the RRM is approved for implementation and before the licensee makes its first RRM submission. Chair, Transnet has implemented a full allocation cost approach by using an activity-based costing approach. Chair, Transnet in allocating costs uses a direct costs assignment for all costs which are can be directly traced to the different business units. And in step 2, all indirect costs are then assigned in proportion to the direct costs for each business unit. And in step 3, all shared and overhead costs are assigned in proportion to direct costs. Chair, on 7 August 2025, Transnet submitted the initial CAM version 2 to NERSA. The CAM was assessed and a summary of the audit findings was submitted to Transnet to respond to how the CAM resolved some of these audit findings. The responses were provided on page 3, the table on page 3, and deemed to be adequate. Chair, on the 7th of October 2025, Transnet and NERSA working group, RRM working group, met to discuss the CAM, and a revised CAM was then submitted on the 31st of October 2025. Chair, on table 1 on page 5, it provides a comparison between the CAM version 1 of 2011 versus the version 2 of 2025. Chair, NERSA assessed the elements of the CAM, and the first element that it assessed was the scope and the business structure of the CAM. It was identified that the enhancements made by Transnet are in line with NERSA's RRM Volume 1 principle of separation, as TPL or Transnet Pipeline separated each business by product or service rendered, therefore ensuring that the cost of each business operations are assigned directly. Chair, we also then evaluated the cost allocation methodology utilized in the CAM version 2. Chair, we have identified that the enhancement made is in line with the objectivity and consistency principle of the RRM Volume 1, as TPL has removed the use of volumes as a cost driver to allocate indirect costs. This enhancement achieves objectivity, as there are no gas volumes transported by the non-regulated business. And as well as this allocation methodology also achieves consistency, as volumes fluctuate based on demand on a year-on-year basis. Chair, in terms of the corporate Transnet corporate cost and overhead allocation, The CAM ensures transparency as it has listed all the overheads and the cost drivers that are used to allocate these overheads. Chair, in summary, the CAM is deemed to have met the requirements of the cost allocation manual evaluation matrix. On table 2, there is a summary of all the salient features of the CAM, and a detailed analysis of these are attached as Annexure A. Chair, the REC members deliberated on the Transnet CAM on the 1st of December for the petroleum storage and pipeline business. Members raised concern about the corporate overheads and shared costs, and how are these costs allocated. NERSA interrogated the cost elements that form part of the corporate overheads. The cost drivers used to allocate these overheads are the total direct costs. This is because the support function costs or the overhead and shared costs are driven by the direct costs of each Transnet business unit. Members also raised concern whether the head office cost allocations have increased by 20%. However, when we assess the CAM, we have identified that Transnet used an 80-20 principle, which is just a prioritization tool in which it is meant to identify the major cost drivers of the costs. So Transnet used the cost drivers that result in the majority of the costs to allocate costs amongst the different business units. Chair, members also raised concern of gold plating of tariffs due to duplication of costs. We have interrogated the OPEX and the CAPEX line items. We can confirm that there is no duplication of costs. In addition, Chair, to avoid duplication of costs, NERSA will also monitor the regulatory financial reports to ensure that costs are distinguished between operating expenses and capitalized expenses. This will also be interrogated in the tariff application submitted by Transnet. Chair, members also raised concern about the decommissioning costs and the piped gas allocation. Chair, NERSA assessed the decommissioning costs of Transnet for the tariff application of 2023-2024 to 2025-2026, which revealed a discrepancy between the other D-Little estimate and the Kent and Templar estimate. As a result of this discrepancy, further investigation and prudence assessment was required before such a cost could be accepted in the allowable revenue formula. Chair, in terms of the piped gas allocation of decommissioning costs, NERSA identified that the Kent and Templar study undertaken by Transnet diverged from the previous approved CAM, as the CAM allocated 4.5% of shared of the decommissioning cost to piped gas, whereas the revised study by Kent and Templar increased the allocation to 15% without adequate justification. Therefore, NERSA has not approved the decommissioning allocation for piped gas until further investigations are concluded. Chair, the recommendations are on paragraph 14 on page 10. Thank you, Chair.
Thank you, Mr. Ngobeni. Members, any questions, issues of clarity or points of enhancement, noting that this submissions, there were issues that were raised this in the previous meeting. Mr. Mkize.
Thanks, Chairperson. Thanks, Mr. Ngobeni, for the presentation. From my side, I think both with regard to submissions on the CAM as well as RFR, they pertain to Transnet pipelines. I think it's very important to categorically state that there's been consultation between PPR, Pipeline Pipelines Regulation Division, and the CAR, the Pipe Gas Regulation Division. I think that must always be there, because we are also trying to also ensure that we don't work in silos, seeing that we are operating on the TPNS principle. So if that could always stand out and be clear and actually be executed. And lastly, I would like to get the understanding of this balancing adjustment that is on page 40 or 40. I know that we're pressed for time. If you can just quickly outline what it means, if that is a proper way of doing it, just to put a figure to balance. I didn't understand it. I'm not practicing in this space, so I would just like to understand that. That's all. Thank you.
Thank you, Mr. Mkhize. Yes, I think we should have indicated that there was extensive consultation done with our colleagues from PPR, and this report was, shared with them, and we had worked very closely in the meeting that we had with Transnet on this scam. And we will ensure that in future such work is indicated, that a consultation was undertaken or done with our colleagues from PPR. And then, Chair, on the balancing figure, the Transnet, based on the accounting policy, revalues the regulated asset base every 3 years. And however, then we as NERSA have our own asset register on the REP, which we increase, we trend over the period of the tariff period, and hence the balancing figure comes in where the REP, according to the NERSA asset register, and which is also used in the tariff application, might be lower than what is reflected in the statutory financial reports for Transnet. So the property, plant and equipment on the statutory reports for Transnet might be higher due to the fact that they revalue those assets based on the accounting policy every 3 years. However, our NERSA asset register might be lower because we trend the asset over the period of the tariff application. So then the balancing figure comes in there where the non-current asset balance is not balancing between your statutory assets and the regulatory financial reports. And then that is recorded as a non-current investment, and is indicated then in the balance sheet for the RFRs as a balancing figure. However, it is correct in the sense that we in our methodology indicated that the REP that we use for tariff purposes will need to be what is approved by NERSA and trended according to our own index. Therefore, I think it is correct because we exactly know where that balancing figure will be and what is causing it. I think that is the principle that we are currently using. Thank you, Chair.
Answer, Chairperson. Thank you.
Thank you. Mr. Ngubeni, just one thing that I've just picked up. I was looking at the 80/20 issue on page 8. If you look at the submission and it should continue to page 9. Is there something missing there, or am I reading that input in an incorrect manner, especially towards the end, page 8 to 9? Do you have the submission before you?
Yes, Chair. I can see the deliberations on paragraph 6.1. There's a table there. I think there isn't anything, Chair, that is omitted there. We were trying to indicate to members how this 80/20 principle is derived by Transnet as a methodology to prioritize which costs are creating, which cost drivers are the major drivers of the cost.
I do get that, but if you look at the last part there, it says an increase in the allocated head office costs would only occur if the revised drivers, and then it ends there, and then it then says Transnet SOC CAM. And I don't think it makes sense without really having to get into details on that. If you can just try and improve that part such that a reader that reads as part can make sense of what is being said. The last sentence, going to the next page, really, it's really not clear. Add note, members, may I take you to the recommendations which are on paragraph 10, which are on page 10 rather, paragraph 14, and the recommendations are that we note the submission on the Transnet SOC's CAM. By show of hand, members, can I get an indication that you do support the submission in terms of having to note it? Thank you, Mr. Mkhize. Thank you, Ms. Masetti. I do note, and I think the team will also take into account some of the enhancements that members have requested. We then move on to the next item, still under the pipe gas regulation, which is item 7. And just to read the title into the record, it's the Transnet SOC Limited pipe gas full year regulatory financial report for the period 1 April 2024 to the 31st rather of March 2025. Mr. Numalo, over to you and your team.
Thank you, Chairperson. It's Mr. Ngobeni again. I think he'll just come in the interest of time on this and the next one. Thanks.
Okay. Mr. Ngobeni, over to you.
Thank you, Chairperson. The purpose of taking into account the corrections done, Chair, I would like to indicate that the purpose of this report is to request the RSC to note Transnet's RFRs for the period 1 April 2024 to 31 March 2025, submitted in compliance with the requirements of Volume 1 of the RRMs. Chair, NERSA evaluated the report covering the administrative procedures, the audit report, the volume analysis, the comparison of the estimates versus the actual data, and the REP analysis, as well as analyzing the decommissioning and the ratio analysis. Chair, Transnet complied with most of the administrative requirements as shown in Annexure A, except the deadline of submitting the RFRs by 30 September. Chair, the RFRs were received on the 3rd of October due to delays in obtaining the necessary approvals by Transnet. Chair, the appointed auditors, SNG Grant Thornton, in its audit opinion, indicated that the Transnet regulatory financial reports fairly represented in all material aspects its financial information as at 31 March 2025. Chair, the auditors have an emphasis of matter on the principle that there is a balancing figure in the balance sheet that is due to the different principal allocation principles. And on table 1 on page 5, Chair, it provides an analysis of the actual volumes from FY23 to FY25. Over the past 3 years, Chair, volumes have steadily increased. On table 2 on page 5, it indicates that the actual volumes for FY25 exceeded the volumes as applied for in the tariff application for FY25. And on table 3 on page 6, it compares the actual audited financials with the estimates used in the tariff application. Chair, it indicates that there's a potential clawback amount as indicated in paragraph 6.1.2, and that potential clawback is as a result of higher operating expenses, and these will be assessed with when Transnet submits its next transmission tariff application. Chair, table 4 on page 7 provides an analysis of the regulated asset base, and it indicates that the REP has decreased by 1% due to the reduction in the revaluation of the REP. Chair, in terms of decommissioning, NERSA did note that in the FY23 to FY26 transmission tariff application, there was a significant increase in decommissioning provision. Members did raise a concern on this increase and requested further scrutiny of the rehabilitation costs. The AG did undertake a statutory audit of the Transnet AFS, and Table 5 provides a summary of the findings relating to the decommissioning costs made by the AG. The AG did not identify any material discrepancy in the management judgment and reasonability of the decommissioning costs. Chair, Table 6 on page 10 indicates that the overall funds set aside for rehabilitation of piped gas, and these funds make up 3.8% of the total reserves set aside for rehabilitation purposes. Chair, on Table 7 indicates then the proportion of shared costs between the petroleum and the gas business. The proportion of shared costs allocated increased significantly, Chair. This is as a result of a cost center rationalization project which Transnet said it undertook during the 2023-2024 tariff cycle. Chair, the overall financial performance of Transnet improved as indicated in the profitability ratios as a result of volumes and tariff increases. Chair, the recommendations are on paragraph 14 on page 16. Thank you, Chair.
Thank you, Mr. Ngubeni. Members, any questions or issues of clarity? Maybe just as a point of enhancement, that paragraph 6.6 on the matter of emphasis that has been highlighted by the auditors of Transnet, and maybe you could just have indicated in a simpler manner to say that do they have an impact or not in terms of the Transnet's regulatory, the RFRs that needed to be submitted to NERSA. Yes, you have given an explanation, but probably it would have been just proper to structure it in that manner to say that matter of emphasis does have an impact or does it not, and then you elaborate in the manner that you did. Other than that, I do not have any issues. Members, do not see any hand from your side. The recommendations are on page 16, paragraph 14, and the recommendations are that we note I'm just trying to get there as well, that we note the Transnet SOX as RFRs for the period 1 April 2024 to 31 March 2025, submitted in compliance with the requirements of the RRM's Volume 1, and this report is attached as Annexure Annexure C. By show of hand, members, can I get an indication that you do support the noting of the RFRs? Thank you, Ms. Maseti, Mr. Mkize, and I do support as well the noting. We then move on to the next item, and I'm told it's your item as well, Mr. Ngubeni. Item 8, which is Sasol Gas full year RFRs for the period 1 July 2024 to 30 June 2025. Over to you, Buti.
Thank you very much, Chairperson. The purpose of this request is to the purpose of this submission is to request the REC to note the Sasol Gas full year audited RFRs for the period 1 July 2024 to 30 June 2025. Chair, NERSA assessed the RFRs covering the administrative procedures, the audit report, the volume trend, the comparisons of the actual versus the estimates using the tariff application, as well as the financial ratio. Chair, Sasol Gas complied with all the administrative procedures as shown in Annexure A. On 15 December 2025, KPMG submitted Sasol Gas's audit report, and in that report, the auditors indicated that the financial statements represent fairly in all material aspects the financial information as at 30 June 2025. Chair, on paragraph 5.9, in terms of the volume analysis, it indicates that the volumes transported by Sasol Gas in FY25 and the volumes are split between the natural gas and the methane-rich gas. And NERSA is currently investigating a small variance that is there between the volume balance report and the RFRs of 1.51%, Chair. Chair, on table 2 on page 5, it shows that the volumes have increased in FY24 compared to FY25, and this is due to a gradual recovery, economic recovery within the Gauteng transport network region. Table 5 on page 6, Chair, provides a comparison between the actual and the estimates used in the tariff application. Our preliminary assessment on paragraph 5.1.8 shows a potential payback. This is as a result of lower operating expenses and depreciation, as well as higher volumes achieved by Sasol Gas. Chair, on table 6 on page 7, it indicates the reserves that are set aside for each of the 3 transmission zones. This table indicates that sufficient reserves have been set aside for each transmission zone. Table 11 on page 11 and 12 indicates that the REB has increased in FY25 and that the major contributors to the increase are the meter and transmission equipment work done, as well as on work done on the mains. Chair, the ratio analysis indicates that the financial performance and position of Sasol Gas is profitable and financially sustainable. Chair, this is supported by the profit margins as well as the funding structure of Sasol Gas. Chair, the recommendations are on paragraph 13 on page 28. Thank you, Chair.
Thank you, Mr. Ngubeni. Members, any questions, issues of clarity, or points of enhancements in relation to this particular submission? Thank you, Ms. Maseti. You may come in.
Thank you, Chairperson. Chairperson, mine is just to indicate to the members that the issue of the discrepancy, it might also be due to the volumes that are reported at different times, even with the volume balance report. So if you look at the volumes, if for purpose of this report, they are looking at volumes from 1st of April until 31st of March, it will obviously be different from the volumes that are looked at from 1st of April until February. Because then that is the time that the volumes will be recorded for purposes of the volume balance, given the fact that the input or the information itself gets submitted in the first or second week of each month. So it would not make it then for March. Otherwise, it becomes 12 months in any event, 12 months a report in any event. So there's a difference of timing. But also, there's information that is submitted for the levies as well. So these things, when they are verified, it must also be checked against that. Just to complete the picture. I just wanted to indicate those things of differences in the timing of reporting and then the compilation of information. Thank you, Chair.
Thank you, Ms. Maseti. Mr. Mkiza.
Thank you very much, and thanks, Madam Minister, for the presentation. On table 5, I'm just a bit confused here when it comes to the issue of clawback, because I take it then it should go in there. Maybe there should be a descriptor, maybe under actual, instead maybe of a number. And then on the decommissioning provision, I'm a bit confused by the fact that you've got that figure there in terms of what was approved. And my understanding is that whatever then gets allocated in practice should not exceed that approval. So that's the issue that I'm not really clear with, and I would just require bit of assistance. Thank you.
Thank you, Mr. Mkize. Mr. Ngobeni.
Thank you, Chairperson. I didn't get properly the first question from Mr. Mkize, but I'll attempt the second one on the decommissioning provision. I think because of the fact that the provisions are estimates, and there might be a point where what is required in terms of the present value of the decommissioning is slightly exceeded. However, at the end of the useful life of the asset, it should be that the amount which has been set aside and the amount which is then required to decommission the asset it should be equal. However, there might be a point in time where there might be an issue where there's an exceedance in exactly what the current present value is required to decommission the asset and what is currently indicated as being set aside. So because of these are estimates, they currently won't be alike or one-to-one. However, what we aim to attain is that at the end of the useful life of that asset, what has been set aside should be equal to what is the present value of the liability to decommission that asset. Thank you, Chair. And I just didn't get the first comment or question. I think if maybe Mr. Mkize can repeat that one, and then I can attempt to answer that one as well, Chair. Thank you.
Okay, thank you. Mr. Mkize, do you want to assist?
Chairperson, I think the issue of the clarification of the decommissioning provision, somehow I'm not necessarily agreeing with that from the point of view that if you approve a tariff and you're setting that decommissioning at a particular level, exceeding that level is actually a additional charge to a consumer, because one can take out the provision and look at it separately in the same vein like one would look at the tariff in its entirety. So please just zoom at that in terms of the principles around you allowing what goes beyond without any subsequent approval of having to go beyond that figure. And then on the clawback side, I was saying that maybe you need to just to define the way maybe it seems like you're saying they did not claw back, or if it doesn't add up as such mathematically here, you need to just write something to that effect, not to leave it just open like that. Because I take it that if you got the tariff, you will then include the clawback as part of how they should then it should add up to the tariff that gets actually charged. And if someone is charging below that, it is still something that is embedded in the tariff itself. So it's just that one must. I'm trying to make sense of the figures and not just take them as they are. If you understand my point of departure, Mr. Ngobeni, I don't want to delay the meeting until so, but I'm saying you can just quickly respond without really wasting time from our side. Thank you.
Thank you, Chair. I think I take the comments from Mr. Mkize, and I think we will enhance in terms of the payback scenario as to how it has arisen as reflected in our submission, and when it will then it be likely be implemented by Sasol Gas. And I think as well, even in terms of the decommissioning, because they have achieved a higher or have recovered a higher decommissioning amount, in our table on the payback, we do indicate that that will then factor into the amount that needs to be paid back to customers, because they have over-recovered in terms of the amounts for decommissioning in our calculation, especially in Table 5. We do indicate that there's a potential payback that needs to be implemented in the 2026-2027 tariff cycle. And one of the contributors is the fact that they do have a lower operating expenses, but as well as that they've over-recovered in terms of the decommissioning cost compared to what was approved in the application. So the net impact is that there must be a payback to customers because of that over-recovery. Thank you, Chair.
Mr. Ngubeni, Mr. Mkhize, I covered. I don't see any hand from Mr. Mkhize. I think what is important. Okay, I think what's important with some of the issues raised by members that are really still at an investigation stage or at an engagement stage with the licensee, it is important that we deal with those that really needs a lot of work before we actually get the tariff application, and whatever conclusion we reach, it should be part of the background, such that it gives members the satisfaction that all the issues that have been raised in other platforms have been covered. So for me, that's what I would like to really provide as guidance to the team. And I think we have noted the causes of some of the discrepancy or variances that have been highlighted, which Ms. Maseti did try and assist in indicating as to what is normally the cost and how these are actually sort of reconciled. So on that note, members, I would like to take you to the recommendations, which are on page 25, and would amend the approval to the noting. Paragraph 13, it says that we, as the committee, should note the Sasol gas as RFRs for the period 1 July 2024 to 30 June 2025, which have been submitted in compliance with the RRM Volume 1s, and these are attached as Annexure C of this particular submission. Members, by show of hand, can I get an indication that you support the noting? Thank you, Ms. Maseti, and I do support Mr. Mkhize. I don't see your hand. Thank you so much for supporting Mr. Mkhize. We then move on to items that have been set for the open session under the Petroleum Pipelines Regulation. We would move on to item 9, and the title for that item 9, it's Wasa Gases Pty Ltd, is the application on the revocation of a license issued for the operation of a petroleum storage facility in Kayasand, Gauteng province. And Ms. Mtwa, over to you, or you could rather direct quickly as to who's going to lead the presentation to the committee. Over to you. Please also be mindful of the time that we have on all the items. Thank you. Ms. Mtwa?
Noted, Chairperson, and good morning, and good morning to the members and dear colleagues and the public that is listening. Maybe just for sake of time, we should then allow for the presenters to just come in, and then I'll then come in and assist where necessary during the question and answer session. But for this one specifically, Ms. Ngubeni will assist with the introduction. Thank you, Chairperson.
Thank you, Ms. Mtwa. Good morning, members, management, and colleagues. I would like to firstly apologize for the meeting date on the cover page. The submission was initially planned for a later meeting, but was brought forward as the processing was completed sooner than expected. I'll consider the submission as read and just highlight key issues. Wasa was licensed to operate one LPG storage tank with a design capacity of 22.5 cubic meters on a leased property. When the owner was unwilling to sell the site, Wasa acquired the adjacent property and relocated the licensed tank there while continuing to lease the original site for truck parking and driver accommodation. The relocation of the licensed tank to the new site was done during NERSA's revocation of non-bulk licenses under the 2016 bulk determination. Since the licensed facility has been decommissioned and no longer exists at the licensed site, WASA applied for the revocation of its license in terms of Section 24(1)(a) of the Act, which states that the authority may revoke a license on the application of a licensee if the licensed facility or activity is no longer required. Following the decommissioning of the licensed site, WASA installed 2 additional tanks of 22.5 cubic meters and 9 cubic meters at the new site, resulting in 3 storage tanks with a combined capacity of 54 cubic meters. Despite the increase in capacity, the new facility remains classified as non-bulk under NERSA's 2016 bulk storage determination. For this reason, WASA submitted a bulk storage verification form for the new site, which was processed and approved by NERSA on 4 November 2025. With respect to the licensed site, Regulation 9.7 requires proof of land rehabilitation before a license may be revoked. WASA provided that no land rehabilitation was needed because the decommissioning exercise only involved removal of an above ground LPG tank, posing no risk of soil contamination. An independent verification by the Department of Forestry, Fisheries and the Environment confirmed that land rehabilitation was not necessary. Consequently, there won't be any certificate issued from an independent consultant stating that the site has been rehabilitated. With that said, we recommend the approval of the revocation application as outlined in paragraph 14 of the cover submission. Thank you, Chair.
Thank you, Ms. Ngubeni. Members, any questions, issues of clarity or points of enhancement that you may have? Just one thing for me on the rehabilitation issue. Does that mean that NERSA is only dependent on the outcome that comes from the Department of Environmental and Forestry and etc., and not required? Therefore, then we are not required to do our own independent assessment of that. If you can just clarify that for me, because I didn't pick it up in the presentation or in the submission. And that's all that I have. Otherwise, I do support the recommendation. Ms. Ngubeni?
Chair, please allow Martin to come in. Thank you.
Morning, Chair and members and colleagues. CEO, the regulations was made in terms of the Petroleum Pipelines Act was changed in 2015. And at that point, it took away the responsibility for that verification from NERSA, and it placed it with the competent authority, which is the DEF or the local authority responsible for that. What remained is NERSA has the duty to ensure that there's funds available. So we always then rely on the certificate. If there is one is triggered, EIA process is triggered from a competent registered environmental practitioner. So in this case, we did contact the environmental authority, and they confirmed nothing was triggered, and as such, there's also no such report that NERSA need to consider. But we have done the due diligence with the department as the competent authority in terms of that post-2015 regulation change.
Okay, so DFFE's submission is sufficient. Members, on that note, the recommendations are on page 6, paragraph 14, and the recommendations are that the REC is requested to approve the revocation of a license issued to WASA Gases Pty Limited for the operation of a petroleum storage facility in Kayas and Gauteng, and to approve the decision and reasons for decision document that has been attached, marked Annex A. By show of hand, members, can I get an indication that you support the approval of the recommendations made to the committee? I do support. Thank you, Mr. Mkhize. Thank you, Ms. Maseti. The submission is approved. We then move on to item 10, which is SA Bulk Commodity Trading and Storage for Services Pty Limited's CAM submission in compliance with the requirements of the RRMs. Ms. Mta, guide us as to who's going to lead the committee with the submission.
Thank you, Chair. Mr. Sintumule will assist. Thank you.
Thank you, members, and thank you, management. Today I'll be taking you through the SA Bulk submission. And the purpose of this submission is to request the Regulatory Executive Committee to approve SA Bulk CAM submitted in compliance with the requirements of the RRMs. Section 2.6.2 of the Gazetted RRM prescribes that each licensee is required to submit to NERSA a cost calculation mechanism for approval as soon as the RRM is approved for implementation and before the licensee make its first filing of the regulatory financial reports to NERSA. SA Bulk submitted its CAM on 23 October in compliance with the requirements of the RRM. Table 1 below, it summarizes the salient feature of the SA Bulk CAM, and I believe that my management will, members will be able to go through the documents so that I go to more important information given the time. In terms of the SA Bulk cost center and the identified cost center drivers, SA Bulk has established cost center to track direct cost incurred. SA Bulk will use the revenue generated from each cost center to allocate shared services costs between regulated and non-regulated activities. Direct costs for regulated activities are allocated directly to those activities at 100%. Direct costs for non-regulated activities are allocated directly to those activities at 100%. Shared service costs, which are indirect costs, are allocated according to the cost drivers, which is determined by the revenue-based allocation. Where allocation by revenue base is not practical, SA Bulk may use the regulator asset-based allocation as possible cost drivers. Now, in terms of what is regulated here, in terms of the SA Bulk, as members have requested before, that information should be shared. Tank P1 is regulated at 100%. Diesel tank is regulated 100%. Administrative, non-regulated 100%. Facilities, non-regulated 100%. Rental, non-regulated 100%. Weighbridge, non-regulated 100%. Track-in, and non-regulated. I also, for members, I've also attached as an extra B, where I indicated the post-cost drivers for SA Bulk, which they indicated that there is number of employees, volume-based allocation, REP allocation, and also I've in extra B, there's a indirect cost, which are ESCO, finance. I do believe that members are calling because there are many there, irrespective now of the time. With that, members, it is recommended that the Regulatory Executive Committee approve the cost allocation manual as submitted by SA Bulk in compliance with the RRMs. Thank you, and over to you, Chairperson.
Thank you, Dr. Sintumule. And Dr. Choke, if you can confirm that this is also for noting and not for approval, please do come in. Chokwe. Well, whilst waiting for Chokwe, let me take comments from members on this particular submission. Members, any questions, issues of clarity or points of enhancements on the submission? If you have any, please do raise your hand so that you can be recognized. Ms. Maseti is fine with the submission, Mr. Mkhize. Dr. Chokwe, if you can come in, I take it that this is also similar to the one that we dealt with on CAM, and I guess that this will be for noting, not approval. Chokwe, please do come in. Or anyone from RSU, please, if you can come in so that we can move on quickly, colleagues.
Chairperson, thanks. I'm here. It's for what has been cited in the submission, Chairperson. Of course, the submission was done before the approval of the new delegation matrix, but still stands as it was. Thanks, Chairperson.
So it will be for approval for now. With the subsequent one, it will be for noting. Is that what you're saying? Dr. Please, can you be attentive and assist the committee in doing its work?
Chairperson, I am attentive. I'm saying this submission is for approval as per the delegation matrix, even the current ones. And I'll check the second one because we thought we have checked them and I think they were in order, but I can just look at it, Chairperson.
Oh, all right. Members, on that note, can I get an indication that you support the approval as read into the record that we approve the CAM submission by SA Bulk in compliance with the RRM requirements? Thank you, Ms. Masetti. Thank you, Mr. Mkhize. I do support. May we quickly as well proceed to the next one? I think it's you, Mr. Sintimile. Please do come in and take it as read and just highlight salient features of what you want the committee to pay attention to. Come in, Tate Sintimile. Mr. Mkhize, your hand is up. Is it the lingering hand?
Apologies, a lingering one. Thank you.
Thank you, sir. Tate Sintimile.
My apologies, Chairperson. Maybe they were just requesting with due respect, because the submission for one, it was on the CAM. From my side, it was only SA Bulk. Maybe the EM can guide me on that. Thank you.
Oh, okay. I see
Ms.
Mahopela, sorry, I saw the review and sorry. Over to you, Ms. Mahopela. Apologies for that.
Thank you, Chair. The purpose of this submission is to request the REC to note Sunrise Energy's RFRs for the period 1st January 2024 to 31st December 2024 for its storage and loading facilities. After ongoing engagement, Sunrise finally submitted its first RFRs on 30 September 2025. For enhancement, I can confirm that the delegation matrix, it's for noting. The difference on our submission, it will be the change of the date from the October old delegation matrix to 27 November 2025, and also refer members to paragraph 60 on the overall conclusion section, which should read the liquidity ratio for the storage and loading facilities still at sustainable level, meaning that the Sunrise Energy can meet its short-term obligation. In terms of the overall analysis of the financial ratios, the analysis of the financial performance and financial position of Sunrise Energy petroleum storage and loading facilities indicate that these facilities are profitable and financially stable, and the profitability ratios for the petroleum storage and loading facility, although slightly decreased, is still considered reasonable, which indicates that Sunrise Energy is able to generate profit and realize adequate return on its asset and equity. The liquidity ratio for the storage and loading facility is still at sustainable level, meaning that the Sunrise Energy can be able to meet its short-term obligations. And in terms of the efficiency, data are recovered on time for Sunrise Energy's petroleum facilities, and assets are also utilized efficiently, although it's still below the standard norm of 1. And maybe just to also indicate that Sunrise Energy has submitted its tariff application for review by the Energy Regulator on 14 January 2026, as it is indicated in the submission that we were relying on the on April 2019 tariff escalated table received by the Energy Regulator. It is therefore recommended that the REC notes Sunrise Energy's RFRs for the period 1st January 2024 to 31st December 2024. Thank you, Chair.
Thank you very much, Ms. Mahupela. Members, any questions, issues of clarity? And I think the recommendations are on page 11 and have been read to the record. But before we go to that, any questions, issues of clarity or points of enhancements? I do not see any hand. On that note, with the recommendation having been read into the record, can I get an indication that the members support the recommendation as indicated on page 11, paragraph 70? Thank you, Mr. Mkhize. Thank you, Ms. Maseti. I do support the noting. We then move on to the next item, which is item 12. And item 12 is on the evaluation of Transnet SOC Limited's audited regulatory financial report for the Tarleton Petroleum Storage Facility for the period 1 April 2024 to 31 March 2025. I think it's going to be, I'll be guided. I think it's Ms. Nsomi.
Yes, thank you.
Ms. Nsomi, please, over to you, ma'am.
Thank you, Chair. The purpose of this submission is to request the RSC to note Transnet audited regulatory financial reporting for the period of 1 April 2024 to 31 March 2025 for its petroleum storage facility, submitted in compliance with the requirement of the Regulatory Reporting Manual Volume 1. In terms of the compliance with the RRM Volume 1, Transnet was required to submit its audited RFRs within 6 months after the end of the financial year, being 30 September 2025. Transnet submitted the audited RFRs on 3 October 2025, which is 3 days after the prescribed deadline. With regards to the audit scope, Transnet RFRs were audited under an agreed upon procedure engagement. The auditors confirmed that all agreed upon procedure were performed and no findings requiring adjustment to the reported regulatory financial information were identified. The procedure performed did not reveal any material non-compliance with the provision of the RRMs. We have assessed the RFRs focusing on the following areas: the comparison of actuals against the estimate used in the tariff calculation to determine the clawback calculation provided on page 4 to page 7, the evaluation of audited regulatory financial reporting through ratio analysis, assessing Transnet's profitability, liquidity, capital structure, and efficiency provided on page 7 to page 13. The analysis of the RFRs indicates that the profitability ratio for storage facility shows that Transnet is not financially sustainable. The liquidity ratio for storage facility remains lower than the general norm of 2:1, indicating that Transnet is not able to meet its short-term obligation through current assets. In terms of efficiency, debtors are not recovered on the turnover period of 30 days for the storage facility, as the turnover period is above the collection period prescribed in the tariff methodology. It is therefore recommended that the RSC notes the recommendation made on paragraph 14, page 17. Thank you, Chair.
Apologies, I'm struggling with the unmute button. Members, any questions, issues of clarity in relation to this particular submission? I don't have any issues from my side. I don't see any hand from the members. On that note, members, the recommendations have been highlighted. They are on page 16, paragraph 14, and the recommendations are that the REC notes the Transnet's RFRs for the period 1 April 2024 to 31 March 2025, which have been submitted in line with the requirements of the RRMs. Volume 1. By show of hand, members, can I get an indication that you support the noting of this particular submission? Thank you, Mr. Mkhize. I do support. Ms. Maseti. I don't see any hand from Ms. Maseti. I think maybe someone can assist. Ms. Maseti is indicated as being on hold. But on that note, the submission is approved. We move on to item 13. Item 13 is on the evaluation of the Transnet SOC Limited's audited regulatory financial reports for the petroleum pipeline system for the period 1 April 2024 to the 31st March 2025. It is for noting, and may we be assisted. I think the presenter is Ms. Sebake, if I'm correct. And over to the presenter. I hope I got the name right this time. Thank you.
Thank you, Chair. It will be Ms. Msom again who's presenting. The purpose of this submission is to request the RSC to note Transnet RFRs for the period of 1 April 2024 to 31 March 2025 for the petroleum pipeline systems. In terms of the compliance with the RRM Volume 1, Transnet was required to submit its audited RFRs within 6 months after the end of the financial year, being 30 September 2025. Transnet submitted the audited RFRs on 3 October 2025, which is 3 days after the prescribed deadline. With regards to the audit scope, Transnet RFRs were audited under an agreed upon procedure engagement. The auditors confirmed that all agreed upon procedures were performed and no findings requiring adjustment to the reported regulatory financial information were identified. The procedures performed did not reveal any material non-compliance with the provision of the RRMs. In relation to the comparison between actuals and forecasted cost with the tariff calculation, the audited results will be used to verify potential clawback adjustment arising from differences between forecasted and actuals performance. This will be considered during the assessment of the Transnet's next tariff application in line with the tariff methodology. From a financial performance perspective, Transnet's petroleum pipelines business remains profitable during the 2024-2025 financial year and demonstrated the ability to sustain its regulated operations. It is therefore recommended that the REC notes the recommendation made on paragraph 14, page 14. Thank you, Chair.
Thank you very much, Ms. Msomi. Members, any questions, issues of clarity, or points of enhancements on this submission? If you have any, please do raise your hand so that you can make your input. I do not see any hand. I don't have anything from my side as well. The recommendations as indicated, they're on page 14, paragraph 14, and it is recommended that the REC notes Transnet's RFRs for its petroleum pipeline system for the period 1 April 2024 to 31 March 2025 that has been submitted in compliance with the requirements of the RRMs Volume 1. By show of hand, members, can I get an indication that you support the noting of these RFRs? Thank you, Mr. Mkhize. I do support Ms. Maseti. On that note,
my hand, I support my hand, and I don't know why it's low. Thank you, Chair.
Okay, yeah, I think there's something maybe problematic with your connectivity because with the previous submission, it said you were on hold. Thank you, members, for the noting. And I think that was the last item that we had on our agenda for the open session of our meeting. And let me thank the members of management and support staff for assisting the committee to take everyone through those items that were open for our open meetings. And also let me thank everyone that has joined us throughout the open session of our meeting, and our session therefore has come to an end and it will now be closed. May I get the assistance of IT to close the streaming of the open session of our meeting, will thereafter proceed with all the other items that have been said for the closed session. And Dr. Matafa, if you